Say good evening to everybody. Can you confirm if you can hear me?
Yes, we can, sir.
All right. Thank you everyone for keeping a date with us again today. The July edition. I'm sorry that I joined late. A couple of events crashed into one another and have to just apply the concepts that Gogo is trying to explain to us. Gogo, please let me hold you there and try to give an holistic overview of what we have looked at in the course of the month and a number of topical issues that has also occurred in the month. One of those cogent issues is on the introduction of the Withholding Tax Regulation 2024. I think that came into being about 2 or 3 months back. And a lot of people have been posting a lot of questions around what does it entail? Is this another form of tax? Does it mean most form of businesses will not pay withholding tax again? Or does this even mean that even the big size companies will not will not be liable to withholding tax again? You will agree with me on that, especially for those who have been following us consistently. We had made a publication on this. I encourage you to read this publication from time to time and also make more discoveries on your own. And the intention is to ensure that together we do accounting practice proud. We make constructive value in our place of work and even amongst our peers, and we stay informed about the dynamism and the trend in the practice. To join me in discussing that today is my colleague, Biodun. I believe she is here. Biodun, confirm if you are here.
Okay, yes, yeah, I can hear you loud and clear.
All right, thank you. And in addition to that, in the course of the month also, we did publish another very salient topic now in audit practice. We call it ISQM 1. For those who have been actively involved in audit practice, you will agree with me that this is a recent standardization that occurred in audit practice. But this time, this standard is not talking about how we audit, but what is expected of firms of auditors or accountants. What are they expected to put in place to ensure that the audit practice is the engagements are actually carried on or carried out in a global or in line with the global expectation or standards, right? This particular standard, ISQM 1, intertwined with 2 other very cogent standards. First of which is ISA 220. ISA 220 talking about the standard that actually introduced quality standardization in the process of every audit engagement. And ISQM 2, which also talks about what are the expectation of the audit engagement partner rather in the course of an audit. So to join me in discussing that today is my colleague Toluwanimi. I believe she is here too. Toluwanimi, you can still hear me.
Hi, good evening, everyone.
All right. There are 2 other sections of our discussion today. Is understanding IFRS 18. You will also agree with me that IFRS 18 is one of the new standard we have in accounting practice. At present, the standard has not totally kicked effect, but early adoption is actually encouraged. It is the standard that throw repeal on our usual IS1, how we present financial statements. What are the things that should be in the components of financial statements when we prepare such? We considered this briefly last month, but because of how cogent it is, we are looking at it again. It is something that every accountant in practice or those in industry should be very much abreast of, because it will change the outlook of our usual components of financial statement. So join me in discussing that today is my colleague Alex. Is Alex here?
Yes, good evening. Good evening, everyone. Good evening, sir.
All right, good to have you again. Then finally, I'm sure Hugo has been having some conversation around that, handling ethical dilemmas in HR practice. What are dilemmas? What do we mean by when do we say something is ethical? There are instances whereby you be in a situations where you are not even sure the right action to taking, right, or the right decision to make. What could be the impact of this decision, right? To discussing that in details with me today is my other colleague, Oluwagbogbo. Please, are you there?
Yes, I'm there, sir. Good evening, sir.
Yeah, good to have you. We did confirm, we did make it open last month that for the general public that may be interested in occupying any of these hot seats, we are making this particular platform very open to everyone, right? So should you have any intention to or any interest to be on the hot seats with me in our subsequent edition, please do indicate before the end of this program so that we can have further conversation with you on that, because we do believe that everyone has something worthwhile to sharing. Then more importantly, because of the value additions, the impact these sessions we've been having has been making, it is very advisable or encouraging for you to also share this good news with your colleagues and other professionals that you think will make impact or even learn from this process. We have made the dates very consistent. It is always the last Thursday of every month by 6 p.m. So please don't wait to be reminded. Share it on all of your social media handles, and let's together do accounting practice proud, right? So without wasting time, let's go straight into it. I like to start with that very burning issues in tax practice. Abby, let me start with you. When we say withholding tax, a lot of people have had issues around it, especially people thinking when withholding tax is being deducted on my invoice or my income, that means I'm paying additional taxes. In a very brief and succinct way, can you tell our audience what withholding tax is, whether it is a form of tax or not?
Okay, so thank you very much, Ko, for that question. So withholding tax is not an additional form of tax. It's only just an advance payment of tax, which should be used in offsetting your income tax in the future. That means company income tax for corporate beings and personal income tax for non-corporate beings. So all that means is that if a particular company has withheld from your invoice, let's say 5% of the invoice amount, in future, when you're supposed to pay your company income tax, the 5% withheld on your invoice value will be used to offset your income tax that you're expected to pay in future, and you'll be required to pay the net. Why for that? For corporate beings. Why for personal? For non-corporate beings, that's those that are being regulated by the personal income tax. Any withholding tax that have been deducted from your invoice across the year will be used in settling your personal income tax for the year. So withholding tax is not an additional form of tax. It's an advance payment of income tax.
Yeah, thank you very much. Thank you very much. Another questions have been burning in my heart, and which some people have private chats me about how to go in about that. Maybe Alex, I will look Alex in on this withholding tax issue. Somebody asked me a question that they issue an invoice to a client, right? Say the invoice is 1 million naira, and withholding tax of 10%, forget about the current regulation, we're still coming to that. The withholding tax of 10% was deducted on that. Eventually, they were credited with the sum of 900,000. So the person was confused. How will that very transaction be posted in their books such that they will be able to recognize that withholding tax? Alex, will you help us with that? Is Alex there? I'm not sure you can hear me. Nimi, would you help us with that? Nimi should also be able to help us with it, because these are part of the things you look out for when you go to audit.
All right. If you could come again. So you said it was 1 million that was the fee, but 10% was withheld.
Yes, so the person is actually an accountant, but great in that kind of area. She has not handled that sort of thing before. So she's asking that, Cole, I got an invoice. We issue an invoice, putting myself in her shoes now. Now we issue an invoice to a client. The service we have rendered is a fee of 1 million, and the client has legitimately deducted withholding tax of 10%, which is 100,000. She's not too sure how she will post that sort of transaction in her books, taking cognizance of the actual fee and the withholding tax there. Do you get me clearer now?
Yes, I did.
Okay. So thinking about that is something very important that must be understood by everybody, because our discussion on withholding tax will not be complete if we don't know how to address this sort of issue. This is also open to everyone on this platform. If you think you have an idea about it, feel free to indicate so that we can rub our understanding on each other. While the audience is thinking about that, Abby, let me come back to you again. Recently, the federal government actually make a publication on what we call deduction of tax at source, Withholding Tax Regulation 2024, right? What do you think this particular regulation is talking about? Or before we even get there, when you say regulation, how is this different from acts? Is that be there? I'm sure.
Okay, yes, I'm there. So, yeah, can you hear me now?
Yeah, I can hear you. Good.
Okay, so the regulation is just an extensive explanation of what the withholding tax law is talking about, the Withholding Tax Act is talking about. So the Withholding Tax Act did not share more light to some gray areas.
Sorry. That is not my question. I said, what is the difference between regulation itself and act? I want people to understand when we say withholding tax regulation, income tax transfer pricing regulation, and all of that. Whenever they see the word regulation used in a tax practice, what do you think it is? Don't relate it to withholding tax that we're talking about at the moment. Just say, how is act used in the context of tax practice distinct from regulation used in context of tax practice?
Okay, so an act is a broader piece of a particular legislation. So an act gives explanation to different aspects of the law. But regulation is more specific, is specifically for that concerned purpose alone. For instance, now we have the CIT Act, the Peter Act, and whatever, but we don't have any act specifically for withholding tax. Withholding tax comes under the CIT and the Peter Act. So the regulation now speaks specifically to the set of rules and requirements for a particular law on concern.
All right. Yeah. You tried. That's a very good attempt. But in a much more clearer view, when we say act in the context of tax practice in Nigeria, and as well as every other countries that practice written law, the act is actually a legislative document. It is so it has a legal backing for that very activity on which it is enacted. For example, if I say Personal Income Tax Act, right? Personal income tax is a form of tax that is expected to be paid by certain categories of people within that category of tax classifications, right? What makes this a legal collection is the inclusion or is the introduction of the act, right? So we can have Personal Income Tax Act, we can have Company Income Tax Act, we can have Capital Gain Tax Act. So the inclusion of the act, they make it a legally or legitimate activity that must be adhered to, right? This particular act is expected to be administered by the executive arm of government in Nigerian context, and the executive arm of our government has actually delegated that responsibility to the tax authorities. So in this case, we are talking about the state internal revenue services and the federal inland revenue services, right? But oftentimes there are things within the act that are misconstrued, that are so confusing, that look so complicated, such that we need judicial decisions or proceedings to be able to address or have clarity on some of those things. So oftentimes regulations are made to help you address a particular intriguing issue within the act for the general or enhanced understanding of every parties to that transaction. So you will also agree with me that there has not been a specific legislation on withholding tax. Why is it? Is because it is not a tax on its own. But incidentally, withholding tax is collected in the course of all of these administration of various taxes. So there are a lot of confusions around it, right? There have been agitations that why do we even have to pay this tax? This withholding tax. Why do I even need to pay my tax in advance? Who should pay? Who should not pay? What should be liable to withholding tax? What should not be liable to withholding tax? So all of these intriguing issues are expected to be clarified by regulations or circular issued from time to time. So recently we've had the federal government issue this regulation through the Minister of Finance. And this is then tagged Deduction of Tax at Source Withholding Tax Regulation 2024. Now, what is the expectations of this particular publication? What is the intent of the government in being able to address all of these facts? Biodun will be giving us a summary of that in just 3 minutes of what the key issues that are discussed in the act, that regulations, and what are we expected to know as regards the regulation. Biodun, are you still there?
Yes, actually, thank you very much, sir. So the regulation actually shed more light to some gray area of the withholding tax withholding tax regulation. So the first of which and the most important thing is that small companies, according to Section 105 of CETA, are companies that have revenue less than the threshold of 25 million. They are now exempted from the deduction of withholding tax, but with some specific criteria. So when we mean that they are now exempted from the deduction of withholding tax, what that means is that if you transact with a small company, that means company with revenue less than 25 million threshold, they are not expected to be withhold from your money, from your invoice value. If you have 18 and if the transaction that you're having with them is less than 2 million naira, they are not expected to withhold from your invoice. So this enables small companies to focus more on their growth rather than compliance costs. So another light that this withholding tax regulation help to share is that companies that are not registered in Nigeria, that is a non-resident company, they are now subjected to a withholding tax, a duplicate withholding tax. What that means is that for a resident company where you are supposed to use 5%, for a non-resident company, it's going to be a duplicate rate of 10%. For a resident company, when you are supposed to subject them to tax of 2%, for a non-resident company, they are now being subjected to tax of 5%. That's a duplicate rate. Another thing the regulation help to clarify is at what point are you supposed to remit withholding tax? At what point are you supposed to remit withholding tax? So according to the regulation now, you are supposed to remit withholding tax for a third-party transaction. They are expected to remit earlier of either when the payment is made or when the amount is due or settled. So what that means is that if you have transaction with somebody, let me say within the period of within this 2024 fiscal year, if you have a transaction with somebody that you are expected to withhold from, let's say before your accounting year end is 31st of December, or not before 31st of December, the payment has not been made. That means the payment has spanned through the next period. In as much that the payment is already due, then you are supposed to account for the withholding tax payments on that transaction. So that means is that the government is liable to asking you to remit the withholding tax payments on every of your accrued transaction as at the end of the year. So one other thing the withholding tax regulation help us to do is it actually give a more clarity on those small companies when they are supposed to withhold from them. So another thing the withholding tax regulation help us to do is that when you are transacting with a small company, they are not supposed to withhold from you, and you are not supposed to withhold from a small company. So I think that's all, and it also gives clarity to transactions that are being exempted from withholding tax. We have over-the-counter transactions. Those are transactions you have that is not contract based. You just have them over the counter transaction. We have reimbursable transaction. Those are transactions in which there is no income, there is no profits, there is no income attributable to them. We also have transaction like the government payment transaction. We have transactions that are exempted from withholding tax. So if you are transacting with a company and their scope of operation is actually exempted from the payment of company income tax or PIT, you are not expected to withhold from them. Company like we have the NGOs, charity company, they are exempted from either corporate income tax, or the company income tax, and the PIT tax. So because this set of companies are actually exempted from the payment of income tax, you are equally not expected to withhold from them. Also, the regulation also puts in more clarity to the fact that withholding tax is not an extra cost. Is not an extra tax, is an advance payment of tax. So what that means is that if you are transacting with a company and the company is telling you to pay them net of withholding tax, you have to be cautious by telling them that the withholding tax you are expected to pay on their behalf is not an extra, is not supposed to be an extra cost to you, the supplier. It's a cost, it's going to be a gain to them. They are going to be using the withholding tax, of course, in what's it called, in offsetting their income tax in the future. So that withholding tax we are supposed to pay on their behalf is not expected to be an extra cost to you, because if you agree with that kind of arrangement and the withholding tax ended up being an extra cost to you, and in your statement of profit and loss you display it there as withholding tax and withholding tax that you've incurred for the premiums, that kind of expense is going to be disallowed. It is not an allowable tax.
Very sorry, I have to cut you here. If I leave the other, we continue to rant and rant. I know she is so loaded, and I encourage everyone. This is not just because whether you are into tax or not. As far as you are an accountant in practice, you are expected to have a good understanding, working understanding of all of these terms, because they are very key. Somebody is putting up his hands, Sulaiman Babatunde, but just give me a minute. I want to quickly address some of those issues that Abiodun has raised. Abiodun has been able to establish the fact that when we talk about withholding tax, it is not a different form of tax. So what should you know as an accountant in practice? When you have vendors that approach you and we're discussing their fee and they're telling you that their fee is net of withholding taxes, it means you should not politely concede to that, because on every transactions or incomes that are liable, they should actually bear their burden of taxes. We've also been able to establish the fact that this regulation encourages everyone, whether small, medium, or big companies, to have their TIN. If you don't have the TIN, then it means even if your fee is 1 naira, it will suffer withholding tax. This regulation also makes us to understand that a couple of years back, the government has given clear concession to small companies that as long as your annual income is 25 million or less, you are not expected to bear any CIT, right? If that is the case, why should we then charge withholding tax, since there is no tax that you will bear in future, right? So these are some of the salient things. Other things that are also addressed by the Act is, at what point should you pay that withholding tax? Should it be what happens where you have had a transaction, but the payment for that transaction is actually delayed? What do you do in that instance? If the transaction you are having is a reimbursement of costs, should you suffer withholding tax? If you have over-the-counter transaction, what we call over-the-counter transaction is transaction relating to the primary purpose for which that very business is established, other than contract and other specific transactions or form of transactions that the law has outlined as being liable to withholding taxes. So take note of all of these things. I encourage you to pick a copy of the regulation, read, and should you have any area for clarity, feel free to reach out to us. We have a group for this particular purpose. If you are not on that group and you are here, please indicate so that you can be added on the group. Before I go to the next guest speaker on this, I'd like to quickly take the question from Sulaiman Babatunde. Please, are you still there, Sulaiman Babatunde?
Yeah, good evening, everyone. Good evening, Mr. Cole and the team. So, quick question on the withholding tax that's been discussed. And my question goes to Abiodun. When you were talking about deducting self-charging withholding tax, if I get you correct, in a situation where we have a foreign company, like we are dealing with a country outside Nigeria, we all know that withholding tax is supposed to be, like you said, it's an advanced form of tax, CIT and the rest. Now, if I'm remitting withholding tax, I'm supposed to remit with the TIN number of the company that I deducted that withholding tax from. In a situation where the company is abroad, how do I, against which TIN number do I remit that withholding tax, and who will be the beneficiary of that withholding tax since the company is not domiciled in Nigeria? That's basically my question.
Okay, thank you very much, Doratile, for that question. So one of the things we need to understand is that even if a company is not domiciled in Nigeria, the CIT or PIT is clear about the income that is being taxed in the country. So for a Nigerian company, you are subjected to tax based on your worldwide income. While for a non-resident company, that is a company not incorporated in Nigeria, you are subjected to tax to the income you earn in Nigeria. So what that means is that even if you are a non-resident company, you are expected to pay company income tax on that income that you've earned in Nigeria. And that is the reason why the regulation is subjecting to withholding tax non-resident company. So you ask the question that for a non-resident company that don't have a team, if you withhold from them, how are you supposed to pay that withholding tax? Sometime in 2019, Finance Act 2019 obligated every company, whether non-resident company or resident company, to register with the Federal Inland Authority of Nigeria. So if you're a non-resident company and you are having transaction with a Nigerian citizen in Nigeria, you are earning income in Nigeria, you are expected to register with the Federal Inland Revenue Authority in order to pay the income tax on that income that you are earning in Nigeria. So now, as a vendor, as a company that you are transacting with a non-resident company, if you withhold from them, how do you remit? You are expected to remit to FIRS. No, that's quite known. So with what thing do you remit with? When you are remitting with FIRS, you leave that thing space there blank at zero. Don't just put zero. So whenever the non-resident company have a thing, you can always go back to the tax formers and update it. The tax former is always there for updating. So I think I didn't get the second question. I think I'm missing. Am I answering your question?
Let me address the other ones. Just hold on. Let me address the other ones. Development in tax practice has made it very clear that whether you are a resident company as being a Nigerian, you have a Nigerian office, or a non-resident, you should bear a proportionate burden of your taxes. Please take note that if you have non-resident vendors that you have been dealing with, or entities you've been dealing with that do not have TIN, right? Because FIRS sometimes, subsequently will hold you, who has been dealing with them, responsible. You can actually generate a TIN for them in proxy. That is why FIRS has a dedicated office called FIRS Non-Resident Tax Office. It addresses all issues related to the non-resident taxes. So let's assume your company has a number of vendors you've been dealing with, you've deducted withholding tax, and you've not been able to remit because there is no TIN there. You can actually get those TIN for them in proxy. So get across to your tax consultant if you have number of issues on that will be well addressed. Then with regards to why they should actually bear the burden of tax, Jordan has addressed that. Wherever you have made an income from, you should make a proportionate contribution in taxes to that very jurisdiction. Then there is one other one that I think you did not ask, but if you said maybe that is where you're actually going. If you have a non-resident company that have borne that burden of tax in Nigeria, how will the person then be able to make use of that? If it is if that particular vendor is from a country who has a double tax agreement with Nigeria, right? What that means is that Nigeria and that country where that company is resident, say the company is in the UK, right? And Nigeria has a DTA with UK. The taxes suffered by a UK resident company in Nigeria will be used as a tax credit in that country when the company wants to file its own tax with the tax authority in its country. right? Take note of that. The same thing is also applicable for your company who has earned income from outside of Nigeria, right? So if you have earned income from outside of Nigeria and you have suffered any form of withholding tax or any form of advance payment of taxes in that very country, when you are coming home, as long as Nigeria has a DTA with that country, it will be taken as a tax credit, meaning you should pay 2 million at the end of the day, but you have suffered 1.4. That will be deducted before you then pay the balance. What then happens if the country where you have suffered that very tax does not have a DTA with Nigeria? So what you will then have to do is that tax you have paid as withholding tax in that country will then be taken as part of your business expenses that will be deducted in arriving at your taxable income. Please do confirm if all your question has been addressed.
Yes, absolutely, Mr. Cole.
Yeah, thank you very much. Please, if you're not on that group, please indicate so that we can get you added to that group. The reason for that group primarily is if in the course of your work you have any intriguing issue, you want a second opinion on something on that, just put it there. We will address it. It is not for any other matter outside our tax or accounting practice, strictly for brainstorming on various matters relating to our practice. Any other question on that before we move to something else? I saw one other hand up sometimes ago. Who else has any question relating to the withholding tax regulation we have discussed? Any other person before we move ahead? Okay.
Yes, good evening, sir. I do have a question.
Please, go ahead.
Okay.
Make it snappy.
Sir?
Make it quick because I said a lot of things once.
Okay, in respect of the payment, the remittance of withholding tax, before now, in practice, it's usually 21 days, either after of the following month or something. Does this new regulation, did it change that when to remit to the FRS or SIRS? That's
okay. Biodu, would you want to address that, or you want me to take that?
So the new regulation did not change the date for remittance of WHT. It's 24 days. If the person you are transacting with is a corporate, then you are remitting to FIRS, and 30 days if it's an individual that you have to remit to the State Internal Revenue Service.
All right. So that's been addressed. So before I jump to one other very important issue that we wrote on in the course of the month, I put up a question before that a company, actually put yourself as the accountant of that very company, you sent out invoice to one of your clients, invoice of 1 million. The company has then deducted withholding tax. Forget about the current regulation. The company has then deducted withholding tax of 100,000, and you want to post that very transaction. You are not sure of how to go in about it. Let me put the question directly to everybody now. What is your view? How do you post it? Because there are two things there. You want to recognize that very invoice, and you also want to recognize the impact of that withholding tax that has been deducted. Remember, we have said to you, it will be a withholding tax credit that you will use in offsetting your future taxes when it is then due. How would you recognize that in that your accounting entry? It's very key. Everybody should be able to answer that. So everyone who is ready to answer that question, Esther, would you want to help us? I have two Esthers here. Esther Zajubi or Esther Wichy? Wichy, would you want to answer the question? Who is willing to answering the question?
Hello, Can you please repeat the analysis?
Okay, please. And for those who might be attending interview, this could also be an interview question. And that's why I keep on reiterating it. All right. You are the accountant of the company. You have sent out your invoice. On the invoice, it is for a value of 1 million. And I said, forget about the current regulation, right? Right. So 1 million and a withholding tax of 100,000 has been deducted on it. How do you post that transaction in your books such that that withholding tax credit is recognized?
To me, I think we are going to that 100,000 withholding tax that they credited. You are going to include it in your as an income. That means you are going to credit in your POA, and the 1 million you are going to debit it in your POA as 1 million. So by the time credit 100,000 and debiting 1 million is going to offset it at the end of the day.
Your 100,000 and 1 million is not balancing. The two sides should be balancing.
Yes. There will be a difference of 900,000 at that end. So that 900,000 is the actual tax that you really paid at the end of the year. That will be like expense.
Okay, let's say thank you very much for your contribution, but we'll get the answer before we go into today. Sahidi Ridwan wants to attempt that. You have the floor.
Okay, thank you so much. In recognition of the invoice, which is the first thing you have to do, your withholding tax credit note will be debited, while the receivables too will be debited with 900. Your withholding credit note will be debited with 100,000. That makes your 100,000. That makes your 1 million on the debit side. While for your revenue, you then credit it with the 1 million. Then upon the payment of that very invoice from that very customer, your bank will then be debited with 900,000, while your receivables account will now be credited with 900,000, just to nil it off the customer's record. And that 100,000 initially recognized as a receivable will be there until you use it to offset your CIT when the time comes.
Can you take that again? I want to be double sure you get it very right.
Okay, at the invoicing stage, you debit your withholding credit note with 100,000, and you also debit your receivables with 900,000, and you credit your revenue with 1 million.
Absolutely.
Then upon the payment, your bank will then be debited with 900, which the customer is paying, while the receivables will be credited with 900,000.
Okay, that is absolutely correct. You have done very well. That will lead me to the next question before we round this very thing up, because that actually means that we are actually practicing what we are discussing, right? You made mention of withholding tax credit notes. What is the difference between withholding tax credits and withholding tax credit notes? Withholding tax receivable and withholding tax credit notes.
Okay, so is that me? Everybody. Okay, if I can just say something to that. The withholding tax receivable, that can be attached to the amount of money which you can still receive, but for the credit notes, it's just there for you to use it against offsetting any other liability that comes your way.
Please, we need to take note of all of these things, especially we as auditors, because in the course of your audit, you might see withholding tax receivable, withholding tax credit note. At what point are they the same, or at what point are they different? Okay, do you want to say something? Quickly have the floor.
Okay, so it becomes a receivable.
Audit. I have somebody from non-KCP. Let's give them the opportunity to talk, because that is the beauty of this session. Jamil, you have the floor, please. Is Jamil there?
The difference between withholding tax credit note It's just the evidence of that evidence showing that the money paid to the FRS has been given. Then the total receivable is the one that will be showing your account that, okay, you are expecting withholding tax from the client that has withheld withholding tax from your account, from your money. So which the difference is that the withholding tax receivable is the one that will show in your balance sheet. Credit note shows that, okay, it has been paid, which you can use to net off in the long run.
Yeah, you are right, but towards the end, you're now confusing us. Okay, but if I understand you right, and that will lead us to the answer Said gave earlier on, meaning one of those entries was not very correct. Maybe the entry is correct, but the particular of that very transaction is not correct. So withholding tax withholding tax receivable, at the point where the amount was being withheld from that invoice, it is withholding tax receivable, right, to the benefiting party, and it is withholding tax payable to the party who has withheld it, expecting to pay it off. Jamie, do you still want to say something?
No, sorry.
Okay. So then when eventually the client confirm that, oh, that money withheld from your fee has now been remitted, it now becomes withholding tax credit note, right? Take cognizance of that, because you need to be keeping track of that movement. If at the end of the day, you want to use that withholding tax credit to offset your liability, you cannot use withholding tax receivable to offset if it has not been validated that that amount has been remitted. So as auditors and accountants, we need to be on a lookout for that and reconcile that with the balances on the relevant platform where you are considering it, whether at the state tax authority, in the case of PIT, right, or with the FIRS tax promas in the case of incorporated entity. I believe we've been able to do justice fairly within the ambit of the time we have on tax practice. Permit me to quickly go consider the next next topical issue we have for today. But please, we will have failed the practice if we don't do more findings on this, and if what we are learning or we have learned in the course of our practice did not impact on our job. Please do well to do accounting practice proud, and everyone that you think will benefit from this kind of sessions we've been having, please do well to invite them to our subsequent sessions, right? We've affirmed that the dates, by God's grace, doesn't change. It's always the last Thursday of every month by 6 p.m., right? One of the other topical issues that we have marked for today is international standards on quality. International standard on quality. What's happening now? ISQM 1. So the standard actually emphasized that this is very core in our practice, and it is intertwined with ISA 220, just like I did mention before, and ISQM 2. Joining me briefly to talk about that is Nimi. I did mention that before, but please, to lay foundation to that ISQM 1 is not talking about what standard we need to apply when we are doing our audits, right? The standard that is applicable when we are addressing various sections of the audit is ISAs, right? But this particular standard that we are referring to, which used to be ISQC 1 before, right, is looking at the firm of an accounting practice. How are you structured, right? What are the things you are expected to have put in place to ensure that all the output from that very practice are as it is expected to be, right? In terms of those structures or components that you're expected to put in will validate the appropriateness or the quality of the output from your various audit engagements, right? To put more light on that is will be handled by my colleague Toluwanimi. Nimi, are you there?
Yes, I'm here.
Yeah, please quickly throw more light on that in 3 to 5 minutes.
All right, sir. So like Coop mentioned, and like I previously mentioned for those that joined early on, ISQM 1, ISQM 2, and ISA 220 were released by the IASB to replace ISQC 1, right? So and the purpose of this is to place a responsibility on audit firms to put a system in place that ensures that the quality of audit reports that is coming out from every audit firm is a very high one, right? So for ISQM, this addresses the responsibilities of the firm to design and put in place quality management system that is called QMS in place. And this is usually at a firm level, right? Usually for quality management, we have what we call the quality reviewer, which is usually most likely the engagement partner in most cases. But because the engagement partner is usually a member of the firm, so the responsibility is not exactly placed on the engagement partner, but rather the firm in this case. So the firm will be the one in charge of putting procedures, policies that in this case would make the firm proactive, right, to addressing risk issues. Previously, the firm usually have a reactive response. So it is a case whereby maybe during the course of the audit, the audit team or the engagement team discovered something that will affect the quality of the report that will be coming out from that audit engagement. Then that is when they'll be putting procedures in place to make sure that they are able to address those things. But what ISQM 1 is now saying is that before you go on any audit engagement, before you're able to do anything at all, make sure that you have all these procedures, make sure you have all these processes in place so that when you end up facing all this kind of risk or whatever you are able to, or whatever you come across on the audit field or during the course of the engagement, you already have something in place to address all these things. So it's no longer a reactive case, it's now a proactive case. And this will also encourage or also build confidence in the audit team that will be going for any engagement, because they know that come what may, no matter what it is, the firm already has policies, already has procedures, already has responses ahead of time that can undo any risk assessment that you are able to find on the audit engagement or whatever. There can be some ethical issues also that might come up, but because of the implementation of the ISQM 1, or rather of the quality management system that is already in place, you're able to properly address whatever issue it might be that might arise during the course of that engagement. I don't know if you want me to go into some of the...
Yeah, let me hold you there. You had been able to establish the fact that ISQM 1 places responsibility on a firm, right? Let's look at it in this way, just the same way you will expect that if you have gone into a bank, a commercial bank, you will not, there are certain things that you will ordinarily expect from them. You will expect to see an officer that will address all customers' issues. You will, by default, whether the customers have query or not, you're expected to see that. You're expected to see those who attend to day-to-day deposits and withdrawals or other tailoring issues and every other component therein. So also, this particular standard places that responsibility on every firm of chartered accountants. So, what are those key things? The standard is specifically mention 8 components. Those 8 components are key issues that must be present anytime an audit a firm of chartered accountant is being set up for professional services, right? Mention some of those key components expected by ISQM 1.
All right. I'll list the 8, then I'll just speak on a few of them. So we have the firm's risk assessment process. We have governance and leadership. We have relevant ethical requirements. We have acceptance and continuance of client relations, and if you have specific engagement also. Then we have engagement performance. We have resources. We have information and communication. And the last one we have is monitoring and the monitoring process, rather. So for governance and leadership, for example, it's expected that in an audit firm, there is a system in place, right, that oversees, or let's say like a leadership system in an audit firm that is establishing or promoting the quality of whatever audits you are bringing out, or whatever audit reports you are dishing out to the public or to your clients in that case. So the firm leadership, right, is there to make sure that the system, that is the quality management system, is put in place. So I can say that without the governance and leadership, every other one might not exist, because if you don't have someone that is standing in the position of leadership to actually put that system in place in the first place, then there will be no system that would ensure quality audit reports. So also we have relevant ethical requirements.
Sorry, before you go in depthly, some of those key components are very germane, especially the one you have mentioned, governance and leadership, right? As you have rightly said, it is expected that everyone that walks into an audit firm or works with that very audit firm should have a clear understanding of the culture in that firm. What are the things they do? How do they do their things? Do they have a policy, staff policy, operating policy, audit practice policy, tax practice policy? You may not have everything at go, but there should be that consciousness in the firm that these are the milestones that have been covered in respect of this particular component, and there is a commitment to actually implementing others. So still under that governance and leadership is what we call the roles and responsibility. That is why you have different cadre in every audit firm, with clear understanding of what they should do, how they should do, and all of those stuff. That is why you should not have in a particular firm the same person doing audit practice, doing tax practice, doing accounting practice, and all of that. If that is done, it means they are acting in contravention with what this ISQM 1 expects of them. So, like we said earlier on, these are just pointers to things that firms or professionals in practice or managing firms should work on if they have not been acting in line with that, right? As a firm, KCP as a firm is on the journey towards also perfecting a process in establishing this. It is because of the fact that we have impacting knowledge as our culture. That is why we are doing what we are doing. And it is also because we want to continue to transfer skills and responsibility to our teams. That is why we put them on the hot seat. And we want to establish or extend that to every other person. That's why we are also inviting you that if you're willing, come and also share the skills you have. But that is under governance and leadership. Nimi, please, can we also talk about this very, very important one, risk assessment process? Are you there?
Yes, I'm with you.
Yeah, risk assessment process. What does the standard expect when it comes to risk assessment process?
Okay, for risk assessment process, the standards expect that the firm is able to identify and also assess quality risk that could impact the firm's ability to provide quality engagement. Right. Personally, I think or I believe that some of these risk might be independent threats, because in a case whereby there's an audit engagement, let's say it's my husband or it's my father that owns the company, there's a very high probability that what I'll be doing might be biased in such a case, right? So the risk assessment in this case is not now financial, maybe risk assessment, it's not the business risk assessment. It is more of the kind of output I'll be bringing out in such a case. So the firm is expected to have identified some of these quality risk and also put in place processes or responses in case the firm meets up with or encounters such risk in terms of or on the course of the audit engagement. And one other thing we should note is that all this risk assessment process is not just rigid, right? It should be able to change. It should be flexible enough to be able to respond to maybe new risk or something different than what you had expected to meet in the course of that audit engagement. So you should be able to adapt to the change in also the firm. So in a case whereby maybe there's a change in structure or there's a change in audit team or there's something that has affected the firm itself, now not even the client you are auditing, the risk assessment process that you have put in place should be flexible enough to adapt to such changes also. Elko, are you there?
Yeah, I'm there. Let's also look at resources. What does the standard expect on resources?
All right, for resources, I would say that resources is generally what we are able to use to carry out our audit engagements, right? We have the human resources, in this case, the audit team, the people that make up the audit team that will be on the engagement. Then we even have intellectual knowledge also, because whoever will be on that audit team must be able to know what they are going there to do and also understand what they are expected and the quality that is expected from the firm also. So that is also very important. Then we have technological resources. Is it a case whereby, let's say you have a team of 5 people, there are only 2 laptops to work with, or each person has the relevant tools that they require? Or is it a case whereby the team members are in a cramped space, they don't have enough space to actually work well? Some of these things that we might not think are necessary are very important and serve as some of the resources that are needed to actually bring forth a very quality audit report also. Then training is also very important, right? In our field, in our work, you know that there are new changes to different things. Example is the IFRS 18 that is coming up now. There are need for us to be up to date with the changes in our field. So training is very important for the staff members also. So these are some of the resources that are needed for the quality management system to actually do what it's supposed to do.
All right. So as we said earlier on, thank you very much, Jimmy. As we said earlier on, it is very key for those managing firms or those planning to managing firms, as you prepare towards obtaining your license to practicing. One of the key aspects that will guide you in putting off a very successful firm that is or that will operate in line with what is expected internationally is this particular standard. So please, time will not permit us to dwell on all areas, right? But we need to bear in mind that there won't be successful practice if your activities are not conducted in line. Please mute your mic if you are not talking. Adeleke, mute your mic. Adeleke, there is a noise from your background. Okay, thank you. All right. So if there is no your practice and its activities is not conducted in line with what the standard expects, then you are not operating in line with what is expected. So we have spoken on risk assessment process that expects you, the firm, to be able to emphasize what are likely potential risks, whether relating to money, whether relating to knowledge, whether relating to skill, whether relating to absence of staff, or the possibility of you making wrong recruitment, putting the wrong staff on a particular engagement, or you not even understanding what the engagement demands of you. Emphasize every risk, right? And assess the possible impact of those risks. What could be the impact if I accept an engagement, I put my team on the engagement, and they don't know what they ought to know about the industry where the company operates? What will be the potential impact? I will likely have a report that is not representative of the performance of that particular firm. So you should be able to identify what is the risk, what is the impact of that, reader is the assessment, then how do I respond to that risk? My response to that risk will be that I should have identified that I have the competent hand to address every issue on that engagement before I accept the engagement. If I don't have the competence to addressing that very engagement, then it's better I don't accept it at all, or I collaborate with another firm that has the competence while I bring the job, and we ensure that at the end of the day, the output of that process is professionally standard, right? We've also mentioned governance and leadership, which talks about the culture. You should have a professional culture in your practice, and you should be able to group people to taking responsibility in various aspects of the practice. Then we talk about resources. Puts demands on the firm to be able to manage the human resources. That's why most firms should have the human resources department, even if because of your size you cannot accommodate that, or you cannot cope with the cost of that, then there should be an arrangement to outsource that particular line of activity, such that whether directly done or indirectly done, you are still measuring up to standard. Then still under that is technological resources and intellectual resources. You should be able to groom and regroom your team in such a way that they will get better by the day, and they'll be able to do their work in a professional manner. Still on this very one, what does the standard expect when it comes to monitoring and remediation?
All right, sir. So in the case of monitoring and remediation, so the firm the standard expects that the firm continually monitors the management system that has been put in place to make sure that in case there are deficiencies or maybe risk assessments that the system that is currently operational has not been able to address, then they'll be able to up their game. Let me put that in quotes. The firm is expected to make sure that regular reviews are done on the quality management system that has been put in place, and also make sure that I think I'll just call it the abbreviated form, the QMS is robust enough to accommodate as much as possible, as much as the firm can foresee, risk assessment and responses to such risk, so that as new things are coming up, there's an update put in place. As new things are coming up, there's an update put in place to the management system to ensure that the system that is there is not archaic or outdated. So it's always expected that reviews are done regularly and feedbacks are also gotten even within the firm, and maybe from one or two clients that are open enough to give feedbacks. So once we're able to get that from even the clients, we're also able to check ourselves as the audit firm to ensure that in a case where there are one or two things that are still deficient, the QMS is updated to make sure that it is able to address such issues.
All right, thank you very much. Then there is usually misconception about what ISQM 1 is as distinct from ISA 220 and that of ISQM 2. Can you briefly differentiate the three?
All right, sir.
Yeah, sorry,
So,
hold on. While you prepare that, Alex, be getting ready. I'll be coming for you now after this. Go ahead, Millie.
All right, sir. So like we mentioned, ISQM 1 basically sets like a foundation, right, for the QMS that is to be put in place. So that is the major thing ISQM 1 does. But when we talk about ISQM 2, ISQM 2 is talking about the quality of, rather the engagement quality reviews now. So while you might be saying that ISQM 1 talks about maybe theoretical things, ISQM 2 is more of specifics, right, of what should be done. So let me give like an example. So for ISQM 2, it talks about criterias that must be met for an audit engagement to be of quality. You know that I've been saying before that, like we mentioned, there are 8 foundations for the ISQM 1. But in the case of ISQM 2 now, it talks more of who should be appointed as engagement quality reviewer, the qualifications such person must have rather before they are eligible for such a position, what the engagement quality reviewer is expected to do also, right? So that's the difference between ISQM 1 and ISQM 2. But if you're not looking at ISA 220 now, ISA 220 is talking about quality control for an audit of a financial statement. Now, this now takes into consideration the engagement team that should be in place, is related in a way also, right, to ISQM 1, because it sort of operates within the framework that ISQM 1 has given us. But the thing I can say that can differentiate it is that it speaks more of the engagement partner's responsibility. So ISA 220 focuses majorly on the responsibilities of the engagement partner to make sure that the QMS is designed properly to align with the firm's objectives. So that is a little bit I can say for now.
All right, so to recap, to wrap that up, I'll put a question to everyone just to be double sure that we have a fair understanding of what we have discussed thus far on audit practice. Can you arrange these in their order from the largest to the least? ISA 220, ISQM 1, and ISQM 2 in their descending order. Which one should be the first, the second, and the third? If you're able to answer that correctly, then I'll be convinced that we have a fair understanding of what we have discussed. Anyone on the group, arrange these three items, these three standards in a descending order. ISA 220, ISQM 2, and ISQM 1. ISA 220, ISQM 2 or ISQM 1, and ISQM 2. What should be the descending order? Anyone? Alex gets prepared. I'll be coming on IFRS 18 shortly. Anyone want to try? Any trier? Should I call names? Anyone?
Hello, let me try.
All right, Ajibade, thank you.
ISQM 2, 1, number 1.
Okay.
ISA 220, 2, and ISQM 1, the third one.
Okay, thank you very much. I need two more triers. Two more triers. Okay, Precious, you have the floor.
Sorry, I think ISQM 2, ISQM 1, and ISA 220 in descending order.
Okay, one more trial. That is exactly what Ajibade said, right? Am I right? Ajibade, you said 2, 1, and 220. Am I right?
No, 220 in the middle.
Okay, 220.
In the middle. ISQM 1 is number 1 for me. 2 is the number 1. So ISA 220 number 2 and ISQM 1 third one.
Okay. One more trial. One more trial. We want to give a try again. Anyone? Try. No, the presenter don't talk. Try. Ola Adieko has not spoken at all. Can you give us a trial? Especially our guests, please give us trial. Razak Olaleye, can you try? Miriam Shitu, can you give a trial? Jamil, would you like to try? All right, because of time, don't forget I said, and you will agree with me, the firm is the largest. Without the firm, the engagement partner or even the engagement or the staff will not have a place to be identified as one, right? ISQM 1 places responsibility on the firm. So that is the largest. That is the first one in descending order from the highest to the lowest. ISQM 1 is the first one. The organization, which is a firm, must put in certain component to ensure that everything that comes out of the process is standardized. That is ISQM 1. Then next to it is ISQM 2. ISQM 2 emphasizes that all those 8 components that you have put in place, right, there should be some coordinating officer that should ensure that this thing work as it ought to be. That is the engagement reviewer or the engagement partner, right? So what are the things that the person should do in? How do we have peer review and the likes? At what point do we have code review or auth review? That is as contained in ISQM 2, right? Then the list of them is now the organization as a firm has put in certain components, which are 8 in number. The engagement reviewer and the engagement partner, we see to the workings of all of these QMS, right? Then we now test these things in each and every engagement we have. So the standard that specifically address each and every engagement is now the ISA 220. That is the third one, right? So it should be 1, 2, and 220. That is the correct one. This very last question I will ask here, I will seek for the answer towards the end of the session. What is the difference between hold review and audit review? Hold audit review and audit review. Thank you very much, Nimi. Alex, let me quickly come back to you. Time is really against us. Alex will be speaking on the summary of what we are expected to knowing on IFRS 18. Alex, are you there?
Yes, good evening. Good evening, sir. Good evening, everyone.
Yeah.
We are all aware. Yes, we are all aware of the latest standard, International Financial Reporting Standard in worldwide. So, and IFRS 18 that speaks to the presentation and disclosure of the financial statement. So, but before we go into the deeply into the IFRS 18, it's best we need to know the reasons why IS1 was stopped and IFRS 18 was introduced. So the reasons are not far-fetched, just that the reasons, one, the IS1 lacks clarity, so there are inconsistencies, lack of financial structures. The IS1 does not address the need of modern financial reporting, lack of transparency and relevance. So it's based on that the IASB sought to introduce IFRS 18. So IAS1 actually speaks to the basis for the presentation of the general purpose financial statement. So that does not mean that every item or all of the items in IAS1 are excluded or should be neglected, are not to be considered while preparing the financial statement. So IFRS 18 just only addresses few new changes that will override what was earlier stated in IAS1.
Alex, sorry, let me pick on one of the things you said. You said IAS1 actually lacks clarity. How do you think IFRS 18 will bring to clarity what was lacking in IAS1?
Okay, so in terms of clarity, so clarity is from the angle of the investor. So investors make use of these financial statements and they use it for the analysis and forecast about the business, because the business are best reflected in their financial statement. So in terms of clarity, IFRS 18 made emphatical or really stressed more on the statement of financial position. I mean, the statement of the financial performance of the entity, that is the profit or loss. So in terms of clarity, so IFRS 18 gave proper clarity to what you consider as operating, what you consider as investing, what you consider as financing. And it also introduced the aspect of subtotals and totals. So that's the clarity that it defines, and it also gives clarity in the way you present the financial statement. For example,
sorry, before you go into that, you said if I get you well, IFRS 18 will be introducing clearly, or will expect the preparers of the financial statement to state clearly what constitutes operating income or operating activity, what constitutes investing income or investing activity, and what constitutes financing income or financing activity. Our audience may not totally understand all those terminologies that you have actually mentioned. So how do we differentiate what is operating activity, what is investing activity, and what is financing activity for the benefit of our audience?
All right. Okay. So what IFRS 18 defines as operating activities are your principal activities, your main business activities in the business. That is all incomes and expenses from the business operation. The main business operation, the principal activities of the business. So, for example, if you are into the business of rendering services, so you know that you have your income, you have your cost of sales, you have your expenses. So at that point, so you know that those are what you classify as your operating expenses and your operating activity. So in the situation whereby you have other incomes like rental incomes, you have interest, or you have dividends, you have interest income, those are what you classify as the investing. So should in case you have issues of finance cost, lease, then those are what you group as the financing activities. So but before I'll close out from that. So for investing activities, so IFRS 18 defines investing activities as income or expenses from assets that are generated, that generate a return. That is where you expected to receive income. For example, rental income, that's IS 40, that's investment property. Then you have the interest income. Then you have something like dividend, or if you have investment in shares or stock or any other form of investment in bonds that you held to maturity or in whatever form, then those are what you group under the investing activities. Then for the financing activities, IFRS 18 defines it that all incomes and expenses from liabilities that involve the raising of finance. So if it involves the raising of finance, then obviously there will be a cost on that finance. So because there is a cost on that finance, so that cost is what you will then be classifying as the financing activities of that business. So items that you can find under the financing activities are finance cost, your lease cost, then you have overdraft cost or bank loan cost. Then any other cost of financing can be added to that category.
Okay, thank you very much. I will encourage everyone to still take time to understudy this very well, because this particular standard will significantly... Can you hear me?
Hello, sir. Lost a little bit.
Okay, so I said for the benefit of everyone, I encourage you to still take time out to study this standard in details, because this standard, when it becomes fully operational, will change the outlook of our current statement of financial performance, so to say, and you will see how you can then liken what we used to call accounting profits and cash profits. What brings about the similarities between them? How can you significantly or specifically identify how much profit has an organization been able to make from its core activity? From the current outlook of our statement of profit or loss, if a company disclose profits before tax or after tax of hundreds of millions, at present we cannot state whether that particular 100 million is arising from its investing activity, which means that these are passive incomes the organization has made, right? Our current statement of financial performance just show us what the total profits is, but with the application of IFRS 18, it will categorize this into various activities that occur, and you'll be able to tell that this company is doing well on investing activity, or what is sustaining his operation is actually because of the passive investment he has made, as opposed to his core primary purpose of being in business. So you will need to pay attention to that, because that is the way to go going forward. This standard will be fully operational, I think, from 2025. So before then, it is essential that you develop skills and competence around these areas, such that when the time comes, or early adoption is also acceptable. From time to time, we'll be bringing this up again, because there are a lot of things to still discuss on it, right? Thank you very much, Alex. I'll be coming back to you. But before I wrap the conversation on IFRS 18 up, I like to give this question. If I purchase an asset used for the business in generating the operating income, now the asset is not meant for sale. I purchase the asset I want to use in generating my operating income. Which activity will I classify the acquisition of that asset to? Is it an operating expenses or investing expenses or a financing expenses? To the general public, please, what response will you give to that question? Ajibade is of the day today.
That will be investment.
That will be investing. Thank you very much. Thank you very much. But the proceeds I make from the activities I make and I use that particular asset for, what will I classify it as?
It will be operating. The proceeds.
It will be operating, right? So you can see some of the confusion we are having, right? Because
I want to ask a question, please.
Exactly.
And with the new IFRS 18 they introduced now, so our statement of financial performance, it will look like cash flow statement.
Not necessarily looking like cash flow statements, because the purpose of cash flow statements is entirely different. Cash flow statement is not actually trying to just categorize the activities into three, but rather is helping you to reconcile. I started with a cash, whether in hand or in bank, of 1 million. And at the end of the year, I'm ending with 500,000. What have I done over the period that makes the money to reduce to 500,000? So it's a reconcile the amount I'm starting with, various activities, what have I generated in cash, right? From before I eventually get the 500 I have at the end of the day. Don't also forget that cash flow statements will only concentrate on cash transactions. So it would entirely be the same, because the statement of profit or loss will still consider non-cash and cash transactions, as the case may be, right? Okay. While cash flow will still remain what it used to be. But the intention of the drafters of this standard is to clearly state, when I pick an organization statement of statement of profit or loss, and I see revenue of 500,000, I should be able to tell what have they done. You will agree with me sometimes that when we have certain revenue, we are even confused whether to call it income or other income, right? So some of this confusion, this new standard will help to addressing that. You will be able to tell. It won't be a case of primary income and other income again. It will be a case of this income is actually coming from the core things we are doing, which is the operating activity. Or this income is coming from the investments that we have made, which is the investing activity. Or this cost is coming from, this cost or income, as the case may be coming from the financing activities that we have been engaged with. So we will tell what has been the major contributor to the success of the organization. Is it just in investing? If the investing is the core act of the organization, can we discontinue the operating and just continue to make the idle fund invested in the investing activity? So you should be able to tell where are the weakness and what can the organization do to improve on it. So that's part of the things we should be on the lookout for. So let's wrap up this section again with the conversation we started before I joined. And Gogo, are you still there?
Yes, sir.
Yeah. So Gogo, you've been talking about the ethics and the dilemmas involved in practice, especially when it comes to HR, right? Can you just in 5 minutes give a wrap up of that? What is it that your audience should know about ethical dilemma and how well can this be addressed?
Okay, thank you, sir. So I'll just give example and how it can be addressed quickly. This in nature, this is when it has like decisions to make, like 2 decisions to make in order to make the company go forward. So I'm going to be giving example, confidentiality versus transparency. So let's say like an employee health condition could affect their performance now. So like the HR must decide maybe they should like inform the management, the senior management about the information, disclose the information to them, or to keep it for privacy. So this is like a dilemma between HR. Maybe they should like tell the senior management that, oh, this is what is going on with this person, or maybe they should just keep it. So that's one example of dilemma. Another one is also like whistleblowing. So let's say, for example, an employee like is caught in like an illegal something now. Maybe let's say outside of work, say an illegal something. So how will the HR just like relieve the person, or they do like internal meeting and try to solve it? So that's is also balancing employee well-being and business need. So let's say, for example, there is a financial downturn in a company now. So like the HR will be in dilemma. Maybe they should just lay off some workers, or they should find a way around it till the company can make some more money. So what are the things that we can do to like address those things? So one of the ethics. So if the company is like code of ethics that they follow, like professional standard, then the HR can use those professional standards to just like get out of that dilemma. Another one is also consultation. HR can take legal advice and also some advice from people, like from colleagues, so that they will be able to like work around the dilemma and make sure that it doesn't affect the growth of the company. And also training and education. So they can also participate in like ongoing training to stay informed about ethical standard and best practices in HR management.
All right, thank you very, very much. I hope you have learned quite a lot from all of the conversation we've had, ranging from the tax services content, the Withholding Tax Regulation 2024. I believe you now understand what a resident company is, what a non-resident company is, why withholding tax is actually charged, who are those entities that are not likely to bear the burden of withholding taxes again, what condition must be fulfilled before that will not be applicable, and we encourage that you read more on that to be able to increase your efficiency. We've also discussed about auditing, wherein we looked at ISQM 1, right, International Standard of Quality Management. It's very key. How is this different from ISQC, right, which is the old standard, right? What is the primary objective of the ISQM, right? What intention does it seek to serve in, right? How will these improve professional service delivery? How is this different from ISA 220, and how is this different from ISQM 2, right? Who is actually responsible for the implementation of the 8 components of the ISQM 1? Most of these things has been discussed today. We also look at other accounting services. We look at a content called IFRS 18. We said this is a standard that has been published to repeal the then IAS 1, presentation of financial statements. Significantly, this will be changing the outlook of our statement of our various components of financial statement, but more importantly, the statement of profit or loss, primarily categorizing all the activities therein into operating, investing, and financing. The intention, we said, that it is to give more clarity, as in Alex's word, give more clarity to whoever that seek to use the financial statement. Know exactly what has the organization done operating wise to be profitable. What has the organization done investing wise to be profitable, and how where and how has the various activities, operating and financing, been operating and investing been financed. So these are some of the key things that we have learned on that. Then within the HR context, we look at the need to strike a balance between ethics and the various confusing states we may find ourselves in the course of our work. Not just an HR person may be in a dilemma, but also as an accountant, as business owner, sometimes we are actually in a dilemma. And dilemma is that state where you are actually not sure of what to do among, which action you could choose among various alternatives that you have. But we've been able to establish that some of the things that could give you a sense of ethical conduct is look at what the law says. If any action you are about to take in is a contravention of any provisions of the law, of course, the law then gives you a sense of directions, right? Look at the trainings that you have undergone. The trainings that you have undergone will give you some sense of directions about what you've been trained to doing, actions you've been trained to taking in certain conditions, right? Look at the practice development, dynamism in the practice, global trend, technological developments, right? All of these will give us a sense of direction to choosing from various alternatives we may have. I believe in this month we've been able to make some little additions to you. We will not close this section without having the final words from the various guests that help us to throw more light on all of the topics that you have considered today. So, Biado, are you still there? In 30 seconds, can you give your final word to our audience? Is Biado there?
Yes, I'm there. So my final words to this is going to be, always make sure you are abreast yourself on every tax regulation that is out there so that you can know how they impact your business and how to easily tackle them in time. So note that the withholding tax regulation has an effective date of 1st of July 2024. That means as at 1st of July 2024, we are expected to start adopting the withholding tax regulation. Thank you.
Thank you very much. So the guests who have helped us to throw in more clarity on the audit practice, Nimi, can we have your final words in 30 seconds?
All right. So what I would just say is that for every person that is currently in an audit firm or looks forward to working in an audit firm, if you are in a firm whereby the ISQM 1 has not yet been implemented, you can bring it up, right? Because this will also help in the long run the quality of the reports and the system of the audit firm. So let's always make sure, like Biodun has mentioned, to keep abreast of changes and developments that might come up in our field. So that is what I would have to say.
Thank you very much, Tolu Animi. And to one of the guests too that help us in throwing more light on accounting services, IFRS 18. Alex, can we have your final word in 30 seconds?
All right, sir. So IFRS 18 will be effective as from 2027, January 2027. So it's important for we as accountants to fully know the nitty-gritty of how the statement of financial position will be presented. So, and it will involve a lot of trainings, a lot of different tutorials, webinars. So we as accountants, we should just keep abreast before that time, so that it won't look like as if we are left behind and we have to pay expensively to get knowledge as regards the IFRS 18. Also, for those accountants that use software to prepare management accounts, so you also need to take into consideration that these softwares need to start making changes as regards how they present their financial statement. So also watch out for that. All right, thank you.
All right, thank you very much. And to the final person, the last not the least, who has also helped in throwing more light to the topic of this month, Oluwagogo, can we have your final words in 30 seconds?
Okay, so when you are addressing ethical dilemma or any dilemma in life, always make sure that you consult with relevant stakeholders and make sure that you seek advice from legal advisors, ethics committees, or even your colleagues to gain different perspective and insight. And also make sure that when you are in dilemma, you carefully consider a balanced approach that is very fair and justified. Thank you.
All right, so all of our audience want to say a big thank you to you. Also to reiterate the fact that this is actually anchored by KCP, a firm of chartered accountants that is committed to continuous learning and development. It is part of our intent to contributing positively to the practice of accounting in Nigeria and globally, and that is the intent behind this very innovation that you are benefiting from. Please do well to help us to propagate these good names, not just because we want to be popular, but because we want to make more impact in as many people as possible, and together we can do accounting practice proud. I wish you all the very best in our August talk shop. Please be on a watch out for the popular conversation currently ongoing in tax in tax practice. That is a windfall tax. You join us next month to having conversation on that. In audit practice, we'll be having conversation around ISA 220, a continuum of what we have just had today. We've been able to establish that quality management in audit practice actually threefold, or addressed by three key standards. We have looked at ISQM today. We'll be looking at ISA 220 next month, rather. And maybe in the upper month, we'll look at the last part of it. Please tell the good news to your colleagues and friends. And on financial accounting, we will also continue the conversation around some of the topical issues that we have that is an extension of this, right? So we'll be looking at IAS 7, because this will further give us clarity on what is operating, what is investing, and what is financing. And in preparedness for us to have a full-fledged implementation understanding of IFRS 18, right? Thank you very much. And the HR team and the corporate communications will definitely advise us on the complementary write-up and this conversation we have on the last aspect. I don't have the exact word for that. Thank you for joining today, and we look forward to seeing you again next month. Do enjoy the rest of the month, and please keep safe. All the best and pleasant weekend ahead. Good night.